The UK-EU future relationship on financial services has developed in a relatively negative way since Brexit. The UK and EU have not been able to agree on a comprehensive deal on financial services, and as a result, there has been some disruption to the flow of financial services between the two markets. And some of those key negative impacts of Brexit on the UK financial services include the loss of passporting rights, which allowed UK financial firms to operate in the EU without having to establish a local presence, but also increased regulatory barriers as the UK and the EU have to diverge in their financial regulations. And there are increased costs for financial firms as they had to set up new operations in the EU or comply with new EU regulations. And there's reduced investment in the UK financial sector as some firms have chosen to relocate their operations to the EU, to Amsterdam, for example. The Trade and Cooperation Agreement, the TCA, between the EU and the UK includes a number of provisions on financial services, but these provisions are designed to facilitate the continued flow of financial services between the market, but they do not provide for the full mutual recognition of financial services. And some of the key provisions of the TCA on financial services include regulatory cooperation. The TCA sets up a framework for regulatory cooperation between the EU and the UK, and this includes the exchange of information, the coordination of regulatory policies, and the resolution of disputes. And there is something on the topic of equivalence. The TCA provides for a process of equivalence whereby the EU and the UK can recognize each other's financial regulations as equivalent. And this means that firms that are authorized in one market can operate in the other market without having to obtain additional authorization. But as I said, they can. And it's the same with the mutual access. The TCA provides for mutual access for financial firms to each other's markets, but this means that firms that are authorized in one market can establish branches or subsidiaries in the other market, but just not directly go in there. And the TCA sets up a mechanism for resolving disputes between the EU and the UK on financial services. This mechanism includes a mediation process and a binding arbitration process. But the provisions of the TCA on financial services are relatively limited. And this is because the UK and the EU were unable to agree on a more comprehensive deal, because it was more on the side of the UK that it's needed. But as a result, there are still some restrictions on the flow of financial services between the two markets. There is no comprehensive deal on financial services after Brexit. The two sides have signed a memorandum of understanding on financial services, but this is a relatively limited agreement, as I said. And the MOU sets out a framework for cooperation on financial services, including regulatory cooperation and information sharing and the resolution of disputes that I mentioned earlier. But it does not provide for the full mutual recognition of financial services between the UK and the EU. And this means that there are still some restrictions on the flow of financial services between the two markets. And, for example, UK financial firms still need to obtain equivalence decisions from the EU in order to operate in the EU market. And the future relationship between the EU and the UK on financial services is still uncertain. The two sides are currently negotiating a more comprehensive deal, but it's unclear whether this will be successful and if there will ever be one. If no comprehensive deal is reached, the UK and EU will continue to operate on a third country basis, which will mean that there will be some restrictions on the flow of financial services between the two markets. And this is likely to have a more negative impact on the UK financial services sector. But the full extent of the impact is difficult to predict because there are still some transition periods. But before the end of the main transitional period, the UK's financial services trade with the EU was based on passporting. And this allows firms in one EU or European Economic Area member state to apply to their national regulator for a range of passports, indicating that they meet shared EU regulatory and supervisory standards in certain areas. And these passports allow firms to establish branches elsewhere in the Union and trade across borders with minimal further regulatory permissions. The UK's decision to leave the EU single market meant the end of passporting. Countries outside the European Economic Area or third countries typically do business with Europe on the terms outlined in the WTO's General Agreement on Trade and Services, the so-called GATS. And there are significant limitations on cross-border trade compared to passporting, and stricter regulatory requirements and supervisory oversight of the EU branches of UK banks. And both sides are also able to impose measures for prudential reasons, such as ensuring the stability of the financial system, which can lead to further restrictions. Some third countries receive preferable access to EU markets on the basis that their laws and supervisory frameworks are deemed equivalent to the EU's, although this access is narrower than that offered by passporting. There are different equivalence regimes for different parts of the financial services sector, which means the EU typically makes a range of equivalence decisions. Some financial services, including basic banking services such as lending and deposit taking, are not covered by equivalence regimes at all. The Commission can unilaterally withdraw equivalence decisions with 30 days notice. That's something people forget a lot of time. Other third countries have attempted to cover financial services as part of a broader FTA with the EU. The Comprehensive Economic and Trade Agreement CETA between the EU and Canada is the most recent example of this. At the start of the Brexit process, the UK hoped to negotiate a bespoke agreement on financial services that went beyond the standard arrangements usually offered to third countries and to retain some of the benefits of passporting. However, the EU was unwilling to offer this because it was not in their best interest. And as a result, the UK-EU Trade and Cooperation Agreement contains few provisions on financial services, leaving trade to be managed through mutual unilateral equivalence decisions. And as I said, the two sides also signed a Memorandum of Understanding on regulatory cooperation in March 2021. At the end of the transition period, the UK replicated much of the EU equivalence framework in domestic law. As of January 21, the UK had granted the EU 27 equivalence decisions based on a framework for third country access to the UK financial markets set out in November 20, allowing EU financial firms access to parts of the UK's financial markets so long as they meet the criteria. The UK's methodology resembles the EU's equivalence framework. But the EU has yet to make equivalence decision for the UK, except for two temporary decisions granted at the end of the transition period, one of which expired at the end of June 21. And this means that UK firms' access to EU markets depends on the rules each member state applies to third country businesses. The financial sector, or the financial services sector, will also be affected by the mobility provisions in the TCA. It allows firms to send employees to deliver services in the EU subject to conditions, with the exact rules varying between each member state. And since the end of the transition period, some business previously conducted in London has moved to the EU or other global financial hubs, such as New York. In January, Amsterdam replaced London as the primary location for European share trading, while London's derivative trading platforms lost 3/4 of their euro volumes to Amsterdam and New York. And around 7,600 financial services jobs have moved from the UK to the EU since 2016, according to research produced by professional services firms in March 21. However, this is far less than the 100,000 losses suggested during the referendum campaign and represents a small proportion of the 1.1 million UK jobs in the sector. But a lot changed with home offices during the pandemic, so we must not forget that. And figures from the Office for National Statistics suggest there has been a realignment of UK trade in financial services away from the EU towards other markets since the end of the transition period. UK imports of financial services from the EU declined by 35.2% over the same period, possibly due to factors associated with Brexit. Although all this travel and other stuff during COVID played a role as well, so it's not 100% clear here. But the share of UK financial services imports from non-EU countries such as Singapore and South Korea increased over the same period. A substantial equivalence decision from the EU seems unlikely, as I said, and the UK government has indicated that it will change the UK's financial services regulatory regime in the hope of delivering a Brexit dividend. Well, I haven't seen any of those yet. In July 21, the Chancellor used his Mansion House speech and an accompanying paper with a new chapter for financial services to set out a vision for the sector. And this included commitments to implement at least parts of government-commissioned reviews. The Lord Hill review on the UK's companies listing regime and the Khalifa review on fintech. And the government hopes that reforming financial services regulation will help firms trial technological innovations and scale up new products, helping the UK carve out a first-mover advantage by acting quickly to set up a new regulatory regime that attracts firms to launch new products and innovate in the UK over other countries. They also hope reforms could drive the financial sector to help deliver the UK's net zero ambitions. Some reforms would amend EU financial regulations that have attracted most vocal criticism from the sector, such as Solvency II. These rules cover prudential regulation in the insurance sector and have been criticized for not taking sufficient account of the specific shape of the UK insurance sector. And the Chancellor also emphasized a wish to pivot away from Europe and instead push for closer cooperation and more cross-border access with other like-minded financial centers in markets around the world. And that means the US, Singapore, and Switzerland. But what they always forget to mention is that Solvency II was brought up to protect the consumers. And of course, the friends of a lot of government officials in the City of London are not so much keen to lose money over consumer protection. And so it's quite obvious where this came from. But nevertheless, in the end, leaving the EU will have a negative impact on the financial services sector in the UK, and it already has, because the EU has no interest in grant them bigger access to the EU market. Services is not such a big part of the GDP of many EU countries, but it's a big part of the GDP of the UK. And the EU has no gifts to give and nothing to donate. So there is nothing of interest there for the EU. The euro clearing and the prolongation of the transition period, well, they didn't do their homework. Happens on both sides, on one side more than the other, but it happens in the EU as well. But that's a thing that will move to the EU on the long term as well. And they have nothing that they want from the UK in the financial services sector, so to speak. And so I don't see a comprehensive agreement on that sector at any time in the near future. And if you're interested in more videos on Brexit or UK politics, the next video is here in the end screen. I'll see you there. I'll be back.